today's topic is regional market outlook and indicator for the emerging market economies. In the previous presentation, as I said, we will try to cover actually, the commodity market, equity market, fixed income securities, exchange rate market as well. One of the best well-known market in the world, and which is one of the huge volume happening there. Just in one emerging market economy, let's say the equity market capitalization is around just $120 billion. But today, in just Euro USD parity, United States and Euro dollar parity, we have a volume of exchange approximately $6 trillion. This is a huge money. So FX market, FX derivative market is big. For that reason, we also cover the FX rather than the commodity exchange rate market, stock exchange, and fixed income securities. Now, we will focus on the regional market outlook first. Then we will go into deep side of indicators for the emerging market economies. The first presentation, one of the best well-known indicator for the whole world, is emerging market equity valuation. As I said, for the who has possibility and opportunity to join the previous classes that is given by me in finance and economics, you can understand directly price to book ratio what we mean, or MSCI what we mean, or TM what we mean. But for the who don't have an opportunity to join the classes that given by our university and me, let me introduce those definitions to you as well. The MSCI is Morgan Stanley index. Okay, this is one of the biggest investment banking, the Morgan Stanley, making the worldwide equity and index analysis. And MSCI is an abbreviation for the Morgan Stanley indexes. And the EM is emerging market. Price to book ratio. This is one of the best well-known indicator and equity valuation ratio. So let's go into deep side what we mean by price to book ratio. Okay, if you understand the notation about the price book ratio, you will understand directly how we make equity valuation and how we can understand what is cheap and what is expensive. Price is the price you see on the screen. Okay, let's say today Amazon have a price in New York Stock Exchange, right? We have an Amazon prices, equity prices in New York Stock Exchange. This is the direct prices reflected on the screen. And the book is, if I calculate what is the real value of the Amazon. Okay, I'm calculating the Amazon factories, Amazon production, Amazon net asset, tangible and intangible asset. I'm calculating the human capital of Amazon, and I'm adding all these sum. Then I have an average of in my mind that the book value, the real value. Okay, if Amazon sell everything, the human capital, cars, vehicles, buildings, factories, everything, all machine, everything, then this is the real value of the Amazon. So if the price is higher than the book ratio, we mean that the price in the market is higher than the value of the real value of the Amazon. So it is expensive, right? Price to book ratio showing, look at this dashboard on the left-hand side. We are here, by the way. Okay, when we mean by what is the price book ratio, we try to understand what is happening here. And let me say this in different words. As you see here, the price book ratio have a chart from the 1960, okay, 1996 until today, approximately 27 years, let's say 30 years. And the price to book ratio is bottom line around 1, and the upper tangible bound for the price to book ratio is around 3. What we mean by 3 here, before the global financial crisis of 2008, what we mean by 3 is saying that the real value of the Amazon is, let's say, $1 trillion. If I sell everything for the Amazon, if I sell Amazon factories, if I sell the Amazon buildings, if I sell the Amazon all equipment and machines, cars, human capital, everything, lands. This is the whole value as $1 trillion. But let's say, what is the exact value of the price reflection in the market for the Amazon? It is 3 trillion, meaning that the real value is 1 trillion, but market makers and investors supposing that it is real value is 3 trillion. But this is not true. So if the price to book ratio is higher than my average, please look at the average here. The average is 1.8. This is directly reflecting that during the approximately 27 years, the Amazon real average value for the price to book ratio is 1. So any value above this average line, if there is a supply or demand side shock, it's not important. If any deviation from this average line, this is showing that how expensive it is, and any deviation from the bottom line showing how cheap it is. Okay, so if I am here, meaning that the MSCI EM is cheaper. And if I am here, meaning that MSCI Emerging Market Index is expensive. So I will not buy anything from the emerging market economies. As you see, during the COVID crisis, the emerging market become expensive. Then after the tapering period, we have lots of capital flow, and this is capital outflow, not inflow, but outflow from the emerging market economies, because the Fed increased the interest rate. Lots of capital flow from emerging market to United States fixed income securities, and then emerging market asset and equities becomes cheaper because it's sold and price going down. For that reason, today, if I say to you, for the whole participant, if you want to put a money in any exchange traded fund, any type of index, any type of equity, any type of stock, if you want to decide on yourself that whether this is cheap or expensive, and whether it is right time to buy this asset or not, you should look at some indicators. And one of the best indicator from this is price to book ratio, and the second one is price to earning ratio. Today, you understand that if price to book ratio is higher than the average, this means that market price is higher than the real price. Market investors supposing that the real value is higher, but this is not true. Real value is lower. For that reason, if price to book ratio is higher than average, it is an expensive asset, and I will not buy anything. And if it is less than my average, like as we are here, today the MSCI emerging market indicator is cheaper. So I can buy the MSCI. So what is the difference between this left-hand side and right-hand side? This is whole MSCI. What we mean by whole MSCI? I have lots of different regions in emerging market economies. East Asia, Thailand, Singapore, Malaysia, Indonesia. And let's say go to Latin America, Peru, Colombia, Brasilia, Argentina. This is Latam. Let's go to the Central and Eastern Europe, CEMA region. Poland, Romania, Bulgaria, Russia, Turkey. Let's go to North Africa, Algeria, Tunisia, and Libya. So these are all emerging markets. And this MSCI index calculating just one index by weighting all those countries with their GDP and market capitalization. So this is for the whole MSCI in the world. But now in emerging market economies, I have different regions. Okay. And I am looking at what is the price to book ratio in this region. So first of all, if I want to buy an emerging market economies asset, I would like to price to book ratio, then I decide whether this is cheaper or not. Then I'm going to in the right side and saying that I decided to put the money in emerging market. So in which country I should? Let's look at the countries here. Left-hand side, Brazil, China, and the all EM, overall EM. And here I have India, and here I have Korea, Mexico, South Africa, and Taiwan. On the left-hand side, by the way, you should look at the definition here as well. The black range is black color is showing the range, the lower and upper prices, bottom and top prices showing during approximately 30 years in which band these prices will move. And from approximately 0.5 to the 3.5, Brazil price to book ratio is moving. For the China, it's 0.5 and 5.5. For instance, the lowest price is 0.5 and the highest price is 5.5. And this green line, this green just one dash is showing the average line, and the blue line is showing the current ratio. So what I should look at here? I should look at this blue and green line. What is my average and where I am today? So the average for Brazil here and the current price is exactly on that. So average is exactly the same with the current prices, not cheaper and not expensive. For China, the average is around 2, but the current price is around 1. China is cheaper. So you can buy anything in China. It is cheaper. Yes, the price is going down more. It is possible, but it is still cheaper. So if I'm not a trader on the desk, I will not look at the prices. I will look at the real value of the asset, and I will first decide whether this is cheaper or not. And today, I can directly say that China is cheap. And the emerging market economies is around exactly on the dashed line, meaning that this is just below the average line, but so close to it. Not cheaper, not expensive, but close to cheaper. So for the India average line is here, but the current is here, meaning that average is less than the current prices. So India is really expensive today in the emerging market economies. If I want to buy any asset, if I want to buy any stock in India, it is expensive compared to the China or compared to the Brazil. Okay, you will look at the indicators in this style. And for the Korea, as you see the average line in here and the current line here, current dash is here. So it is like exactly with the emerging market overall average. So not cheaper and not expensive. Mexico, not cheaper, not expensive, because average is on the line of the exactly the current dash line. But the South Africa, average is here, but the current ratio is here. South Africa is really cheap because during 75 years, 25 years, I have an average line around 2.5, but today the current value is 1.5, meaning that approximately 33% less than the average line, meaning South Africa is cheaper 33% of their real value. I can buy anything from them. And for the Taiwan, it is not cheaper, not expensive, but close to expensive because current dot is above the average line. Okay, so yes, I know this is a little bit analytical presentation. Yes, I know these have lots of need, necessitates lots of knowledge about economics and finance. But from digging the deep style, we couldn't reach the reality. So the learning is our priority. And second, we should know all related notation in economics and finance. And today, one of the best well-known is price-to-book ratio. So I hope every attendances clearly and crystal understand that price-to-book ratio showing me how is the real value of the asset, what is the real value of the asset. And by looking at that indicator, I can decide whether this is cheaper or not. Okay, this is one of the best well-known indicator to decide this asset, this country, this index is cheap or not.
Abdulkadir, how do you factor risk into this?
Okay, perfect question, Dr. Lambert. Exact and perfect question. When we look at our previous slide, as you remember that our range for the emerging market economies, for instance, for China is 0.5 and 5.5, meaning that approximately 5 dot volatility in the emerging market economies. If I reflect any developed market economies here, you will see the lowest value is 1 and highest value is 2 because there is no volatility there. the price not going up to 2, not going down below the 1. But in the emerging market economies, we know that directly we understood from the principle of the risk concept. We will first look at this, Dr. Lambert. While we are looking the valuation, we first look at the price earning, price book ratio, and the risk-free rate. What we mean by risk-free rate? Risk-free rate showing the 10-year yield plus the risk premium. Okay, risk premium, meaning what is Turkey's 10-year yield today? It is around 18%. What is the risk premium for Turkey? It is approximately 500 basis points, credit default swap. So risk-free rate for Turkey, 18 plus 5, meaning 23%. So in price to book ratio, in price to earning ratio, we are reflecting, and in market pricing, we are also included in those indicators as risk premium. So when you look at the price to book ratio, it is also included the risk premium there. According to the risky asset and risky prices, this price to book ratio can be calculated. Okay, we are not looking at just this is the value, just this is the value. Okay, so this is risk adjusted price, not just the nominal prices. These are all risk adjusted prices in the market. I think this is clear for you. Okay, thanks. Let me move to the.
There's a question.
Yeah. Let me look at the chat side first.
It's from Tom Kisembo.
Hang on a sec. Yeah, I'm in the chat side. Hang on a sec.
From Tom Kisembo. Thanks, Doctor. Yeah. Any possibility of the situation? Do you see that question?
Okay. Tom Kisembo. Okay. Thanks, Doctor. Any possibility of situation in developing market economies? So we can complete picture of understanding of all categories of the market, including their limiting factors and available but untapped low-hanging fruits for their development. Yes, exactly. Because lots of people today, first of all, you should understand this. A few days ago, one of the best friends of me asked this question. From this question, you will understand what the emerging market economies should achieve to be at developed market economies. Okay, how we can look their overall market indicators and what can we understand from those indicators. One of the best friend of me asked this question. Kadir, HSBC and UBS, these are the best well-known investment banking in the world. And they are giving a forecast for the Turkey. For the United States dollar, Turkish lira, at the end of the year, approximately 33. And today, the current price is 30, meaning that if they bring the dollar, they have only 10% of depreciation of their dollar, because they will bring the dollar as 30, and when they bring their money to the United States, they will convert their money from 33. So they will lose approximately 10% from the exchange rate, right? This is their exchange rate risk. And if they bring their money, if they put the Turkish bank asset deposits, they will get approximately 45% deposit rate, meaning that at the end of the year, I will get 45% deposit return, and because of my currency risk, I will lose 10% and my net return will be 35. So why those countries not bringing money to Turkey if they have 35% of the net profit? Why? What is the risk? Risk is here, there's one. Standard & Poor's, Moody's, Fitch, these are the credit agencies all around the world. And these are looking all the indicators: gross domestic product, inflation, budget, fiscal discipline, current account balance, exchange rate risk, risk premium market, stock exchange, volatility. Every indicators they are looking, and they are attaining a grade for your country as out. Like, for instance, for the United States, AAA minus. For the Germany and Australia, A plus. For Turkey, it is BB minus. What does this mean? Below the investment. So if somebody in the world bring the money to an asset and they want to search for which country I will put this money, they will not see Turkey in the list because Turkey is not in the list of the investment grade. Okay, Kenya is not in the list of the investment grade. They are not bringing money. So what should we do as Turkey, as South Africa, as Kenya, as Somalia? What we should do to become an investment grade country? We should first achieve a price stability, approximately less than 5% of the inflation year over year. Second, we should achieve the budget discipline, meaning that less than 3% of the budget deficit. Then we should achieve the exchange rate less volatility, lower volatility, meaning that the year over year implied volatility of your domestic exchange rate should be less than 10%. Four, the current account balance, meaning that export minus import over GDP should be less than, current account deficit should be less than the sustainable level of the financial stability, around 5%. So if you are in the list with 40% inflation, 10% of budget deficit, you will not be even any candidate to become a developed country, not a candidate. Okay, to become a candidate, you should achieve the price and financial stability in your domestic market, not just price stability, but also financial stability should be achieved in the domestic economy. Okay. Then let me pass other question, because another question I think here, rather than the Tom Kisembo's question, I think it is done. And let me introduce the second question. It's not a question, it's an explanation for Dr. Lambert, an exact explanation. The risk-free rate of return refers to the theoretical rate of return of investment with zero risk. Exactly. No risk. Okay. The investor won't accept risk greater than zero unless the potential risk rate of return is higher than the risk-free. Exactly. If my risk is higher than the risk-free rate, why I will bring the money? I will wait, I will lose the time, and secondly, I will lose the money as well if the risk is greater than the risk-free. I will lose two things, not just the money, because you can compensate the monetary loss if you have enough time. But if you lose money during the 40 years every day, you will not compensate it because maybe you will just live 20 years more. Okay, the time is more than precious than the money. Time is everything. Okay. So let me continue the presentation with the next slides. As you see here, this is China equity price to book ratio. Why China is important? China is everything for the emerging market. For that reason, because China is something from the space, not in this world. China not in this world, ladies and gentlemen. China in any indicator, not in this world. Even in production, even in consumption, even in investment, China is not coming from this world. They are coming from the maybe moon or space. They are different. For that reason, because they are making worse or better the emerging market average line, they are reflecting the emerging market equities in this style. Emerging market, parentheses, minus China, meaning that China is not in the list. If I add the China, everything is changing. Okay, so China is something from the space, and this is showing the China price to book ratio in the equity. As you see here, before the global financial crisis, as you see here in the screen, before the financial crisis of the global financial crisis in 2000, as you see here, we have directly China MSCI price to book ratio. It is higher than the 5.1. What does this mean? The China real value is 1, but the prices in the market is 5, meaning that China is 5 times higher and expensive than its real value. before the global financial crisis. 5 times higher and expensive than they really value. And then after the global financial crisis, it is really converging and downwarding to the real value. It is around here. Maybe the China, let's look at the China. What is the China average line? It is 1.8, around 2. So the China average line will be here. So any point above this line will be expensive for China. And any point below this line will be cheaper for the China. And if I'm here in the China for the 2008 global financial crisis period, this means that China is really expensive. And today, as you see, we are here. But the China average line here. So China is cheap. China really cheap today. You can buy anything from China. You can buy any stock from Chinese economies. It is really cheaper. Yes, if you buy here, it can be go 10% or 5% lower again. But this does not change the reality. China is cheap. And this is the most important message. This is the most important message I can give to the attendances. Price can change today and can come back tomorrow or 1 year later. But this reality never changes. Everything will converge its real value in the long run. Don't forget this reality. Everything will converge to its real value in the long run. If China real value is here, and if China in the short term drop, it will be converged to this level in the long run. Maybe 1 year later, maybe 1 month later, maybe 5 years later. But at last, it will converge to that real value. So you are not trader in the desk in the New York Stock Exchange. You are investor. And if something is cheaper, don't think, buy it. Okay. If something is cheaper, don't think, buy it and sleep. It will converge its real value in the long run. No worry. Okay. Don't look at the screen and the prices every day. And here, as you see from the dash line, MSCI China historical growth period for the how much in the crisis and shocks the China stocks drop, and how much period it will take to reconverge to the average line again. So, as you see here, during the COVID crisis, we have approximately 60 basis points. This is the base point, and price returning local currency. So China is approximately decreasing 60 basis points from their average line, and really cheaper. This has only happened approximately 20 years ago and only in the crisis period. So China is cheaper and you can buy the China. This is the contribution to the headline GDP growth in China. And for the percentage point contribution to the headline percentage of GDP growth. And here, as you see, the dark blue line is my consumption. And my consumption, because of the incentives in the economy in China, the consumption is increasing. But the worst case for us, what is the most problematic case, is the net export, this dash line. China is an exporting country. China is a production country. China is producing for all of us. China is producing for the United States. China is producing for the Germany. China is producing for France, Kenya, Somalia, Libya, Algeria, Tunisia. China is producing for all of us. And they are the net export. For instance, United States is the net importer of the country. They are importing more than their export, but China is not. China is exporting everything and importing less than. But because of this dash line going down, net export is decreasing in the China, meaning that the global demand for the Chinese product is decreasing. Okay, so they are not exporting more than they are importing, and net export is decreasing. Net export means export minus import. So this dash line telling us that briefly, the global demand decreasing for the Chinese product, and China is not exporting more and more for the rest of the world, and net export is decreasing. So this is also decreasing the GDP growth because net export is a positive contribution to GDP growth. Investment is almost stayed approximately 10 years because China is not growing with investment today. They are growing with consumption and net export. For instance, Turkey trying to increase their GDP growth with consumption, but then they contribute and converted their consumption-driven economy to the investment-driven economy last 5 years. We increased the consumer credit rate and decreased the commercial rate because we don't want to put additional contribution from the consumer side, but we want to take it from the commercial side. Why? If you use commercial credit more than consumer credit, you can invest, you can put factory, you can create employment. But if you only use consumer credit, you will only increase the inflation. Not okay. If the consumer credit is increasing, they will not open factory, they will not create employment, they will not decrease the cost, they will just increase the inflation if the consumer-driven economy is increasing the cost. So investment-driven economies will decrease the cost, will increase the production, will increase the employment, and then decrease the prices and increase the growing economies perspective. And here we are.
So many people say that China is in collapse over the next 10 years, and it looks like it's beginning.
Yeah, this is one of the perspectives. And one of the perspectives saying that China grows so much during the 2010 and 2012. During 10 years, every year China grow higher than 6%. And 6% increase for Chinese economy, meaning that every year China is growing more than Turkey, whole economy, because Turkey's overall economy is $800 billion and Chinese economy $15 trillion. $15 trillion, 6% is $900 billion. So every year China's growing rate more than the whole Turkey. And this is huge. This is not comparable. This is extremely high. So it will just make a soft landing, not collapse. Soft landing. Because you have a capacity, right? You have a capacity. And if you consume and if you run out all this capacity, people will die. Economy will die. Land will die. So you should need a little bit rest, a little bit patience and slowing down, not collapse. Soft landing.
Well, they say that there's not enough young people in China right now to keep the economy going.
Exactly. Exactly. I mean that you have a capacity. You have a capacity, production capacity, consumption capacity. So if you want to do this everything, let's say, Dr. Lambert, this is this. You are a human and economy is also a human. If your capacity is running 2 kilometers with 10% speed, this is good. If I increase your capacity, running capacity to 20 velocity, but if I ask you to do also you will run 2 kilometers again, after 1 kilometer, you will, because it is not possible. Okay, you will run out of your energy. Producing, who is producing in China? People. And these people are getting older. This land is getting older. These factories and machines getting older. So they are not young. They are not new anymore. Okay. So you have a capacity. So you should need a little bit slowing down your race, not collapse. Slowing down and make a soft landing on your capacity. Soft landing. And here, as you see, we have the MSCI, Eurozone, and US relative performance in the market indicators. This is directly showing us how the Europe is outperformed the United States. As you remember, we are looking all indicators in the regional market. For instance, Eurozone is a region, US is a region, North Africa is region, North America is region, Central and Eastern Europe is a region. So I'm looking here at one of the region, Eurozone, and I'm comparing it with the United States relative performance. As you see, during this September and May, approximately 1.5 years. During this 1.5 years, Eurozone outperformed the United States. But today, Eurozone is less performed than the United States, relatively approximately 13% during approximately 6 months. Why? Because Eurozone is a production economy, but the United States is a financial market economy. If the interest rate is increasing, nobody is opening a factory. Nobody going to market to build home. Nobody buying a new machine in Eurozone. And because of the increasing interest rate, all production, all export, all demand drops down in the Eurozone. And Eurozone economy has a collapse, around collapse, recession environment there. But the United States better. Why? Because Eurozone is a production-oriented economy, but the United States is a financial market-oriented economy. And any increase in the interest rate will stop down all production-oriented economies in the world. Okay, so Eurozone is relatively has a disadvantage of this interest rate hike process compared to the United States. And what is this? One of the items in our balance sheet and income statement. This is net debt to equity. Net debt is my cash, and cash resemble asset, which can be converted into cash in just 2 days. Okay, cash and cash resemble asset minus my short-term debt, meaning that how I am capable to make my short-term debt with my cash side in 1 day, in 2 days. For instance, I can go to a mortgage with its 10-year maturity. I'm not saying this in the net debt to equity. Okay, so net debt is my cash minus my short-term debt. This is my net debt. And equity, what I am putting as an own capital to my company, to my economy, to my asset. Equity is this, not the debt, but my own asset. If net debt to equity is slowing down, this means that my debt is increasing and my equity side is not. If I have a shock, it is not. So I can directly say that if net debt to equity in the market, net debt is my problem, right? This is my debt. If my debt to equity is increasing in the market, this is not. My equity is decreasing or my net debt is increasing. This is not good, and this is not can be capable to turn out in the long run. I should find a solution. So the two-case solution for net debt to equity ratio is this. Either I should decrease my short-term debt, or I should increase my receivables and cash side, or I should have additional equity, common capital to my company, to my country, to decrease this rate. If my equity is relatively less than my net debt, I will eat from my net equity at the end and go to the bankruptcy, collapse. Okay. I think here another question. Why China is not affected by the climate change? Not necessarily. It is directly affected. They have lots of environmental and social governance solution as well. But it is not today's topic. I will complete the presentation first, then I will look at that question and that answer as well. MSCI Europe excluding financial EBIT margin. EBIT means earning before interest and taxes, meaning that I have, let's say, I'm a factory, I have sales, turnover, then minus my cost. This is my gross profit, right? I'm selling something and I'm calculating my cost and decreasing it. Then I'm reaching a gross profit. Then to calculate an EBIT margin, I am from the gross profit, I'm excluding the operational cost. Okay, operational cost, salaries, operational side, anything. And this is my EBIT margin. And from EBIT, earnings before income, interest, and taxes, I have an EBIT margin. Then after EBIT, I'm decreasing my interest expense and taxes, and I will reach the net profit. So EBIT is one of the best indicators for the profit margin. And MSCI Europe EBIT margin is good here, normal, but the average is here. So MSCI problem of the Europe is not about the profit margin. It is about the sales turnover. Okay, turnover is decreasing. They are not selling the higher products to the rest of the world. Margin is good. I'm selling and it is still profitable. But the problem is I'm not selling more. I couldn't selling more to the rest of the world because of the interest rate. Now, like I'm here, compared to the Eurozone with relative to the United States economy, now I'm comparing how the emerging market economies and developed market economies can be comparable. And here, as you see, in January 23, okay, emerging market economies is well compared to the developed market economies. But after the rate hike process and tapering process, emerging market economies is really collapsing. From 100, approximately 12% decreasing compared to the developed market economies. What is the problem here? If the interest rate increasing, lots of capital outflowing from emerging market economies and going to the developed market economies because they are less risky. Fixed income is less risky, equity is less risky, and those countries are less risky compared to the emerging market economies. So what should happen to make this index to upward? Interest rate should decrease. When the interest rate decrease, the risk will be decreased. And because the return is less in the United States, then the money go to the Thailand. Money go to the Malaysia. Okay, relatively higher interest rate environment. But if the United States interest rate today is 5%, no money will come to the Somalia or Turkey or Russia because United States interest rate is sufficiently enough for the investor. To money go out from the United States, interest rate should decrease in the United States. Now I have optimistic consensus forecast for emerging market economies to net margin to expand from 9.4% to 10%, 10.4% in 2012. So net margin means net profit margin. A few seconds ago, I said here, look at this one, EBIT margin. What is EBIT? Earning before interest and taxes. Then from those EBIT, if I decrease my interest expense and taxes, I have now net profit margin. Okay. And here, if I have net profit margin, normally in emerging market economies, net profit margin is around here. But to increase those margin to this bottom 7.2 and 11.6 margin, we should do this. First, the recessionary scenarios and environment and expectations should go down, should be evaporated. If there is a recession probability in the world, there will be no increase in the net profit margin because we couldn't sell any product to the rest of the world. They will not buy because in a recessionary and crisis environment, nobody will produce more. They will decrease their consumption, they will increase their sales. Okay, in recession. And now one of the best important country, as I said, MSCI China. China 12-month price earning ratio. What the price earning mean ratio? How I am cheaper. If price earning higher than average, I'm expensive. If price earning less than the average, I'm cheap. Look at the average line. It is 11. What is price earning today? It is 9. So I'm approximately 20% cheaper than approximately for my 30 years, 20 years. So China today cheaper. China in COVID expensive because average line is 11. But during the COVID, China not affected in production growing. They are really good. They will not close everything. So their price earning ratio is around 19. But today it is just 9. So during the COVID, China is expensive, but China today is really cheap. And this graph directly showing MSCI Latin American countries, because they are also in emerging market economies, lots of Latin American countries, Brazil, Argentina, Peru, Colombia, all these countries are Latin countries and they are emerging market. And versus broad dollar, meaning that how the MSCI Latin correlated with the broad dollar indexes. What we mean by broad dollar? Broad dollar is DXY. DXY is dollar spot exchange rate. So if dollar, by the way, this broad dollar is inverted, meaning that if this is higher, dollar is getting strength and emerging market is losing. So if dollar getting strength, look at the broad dollar. This is gray line. If dollar getting strength, Latin American countries MSCI index is decreasing, right? Because if this is decreasing, this is increasing. Look at the numbers. This is inverted. Right hand side is inverted. If the dollar getting strength, Latin American countries indexes is losing strength, or vice versa. If dollar here, as you see, losing from 130 to approximately 115, then I can directly say that this is exactly what I mean. Dollar losing strength and Latin American countries getting capital. And here I have two tables, but I will not go into details of this table. These are showing the Asia and Chinese market consensus for the next year. For instance, here I have Asia market base case index target. And as you see here, most of them is emerging market: China, Taiwan, Korea, India, Singapore, Indonesia, Thailand, Malaysia, and Philippines. And these are what is the current level of their indexes and what is the year-end target for those economies. So I'm